Howdy everybody, and welcome back to another stock analysis video. Today I would like to give all of you guys an update on the company Salesforce, a company that we've done in the past before, and well, seeing that the market has sold off, and this one was one that sold off a huge amount, let's see if maybe now that has fallen, maybe it becomes an even more attractive price for us to buy. So with that said, let's get started with this analysis. We are going to come right into the calculator, guys, because, well, Salesforce doesn't actually pay a dividend. Ticker symbol of CRM, market cap of $164 billion, PE of 111.36. So, yeah, just like before when I analyzed this, this is still looking like it's significantly overpriced, even though, guys, if you take a look at Salesforce's graph, we can actually see that the highest that they've ever been was around $312 or so, and they've currently fallen all the way up to down $165.10. So this is still telling me that this might still be overpriced from an earnings perspective. However, let's take a look at the cash flow, let's take a look at the shares outstanding, and come up with an assessment as to what we should be buying based off of those metrics and not just the earnings. Now, because they don't pay a dividend, this means that this 5-year average free cash flow of $3.6 billion is going into themselves to pay down their debt, to buy back shares, and of course just grow the company in general. Taking a look now at some fundamentals, the first thing I would like to just point out is that last time I actually did this, we did not have this metric here for 1 year ago. So pretty much we got the newest numbers right here today. So just take that into account when analyzing this, is that everything got shifted one over to the right. So net income 5 years ago of $360 million to 1 year ago of $1.4 billion. That's an increase of 301%. And honestly, well, we can see a nice anomaly here 2 years ago where they did $4.1 billion. Well, if you know anything about Salesforce, you know that this company is mainly directed towards businesses and allowing businesses to use their software to make business easier for other businesses, right? Well, we know what happened in 2020. Nobody was going into the office, meaning that a lot more companies needed their CRM in order to function. This is probably why it just exploded 2 years ago to $4 billion. Now, it came down because, again, more companies are probably canceling, and since companies are going back into the office, they probably saw a decrease in this. However, nonetheless, it is still an increase, but if you take a look at the grand scheme of things, you can pretty much just see that this is still all over the place. They are growing their net income, don't get me wrong, but it's not as rosy as it should be. What is rosy though, and this is actually looking very, very good, it cannot get much better than this, and that is the free cash flow. Cash from operations less your capital expenditures, the lifeblood of the company. Guys, look at this. 5 years ago of $2.2 billion to 1 year ago of $5.3 billion, increase of 140%, which we just saw an average 5-year free cash flow of $3.6 billion. Now, while this increase of 140 is really impressive, what's even more impressive is how much they've slowly and consistently increased this cash flow. 5 years ago of 2.2, 4 years ago of 2.8, 3 years ago of 3.7, 2 years ago of 4.1, and 1 year ago of 5.3. That is the smoothest increase that I've ever seen, honestly, when it comes to their cash flow, and pretty much just telling me that they might continue this consistent increase into the future as well. Now taking a look at the revenue, another great increase too. 5 years ago of $10.5 billion to 1 year ago of $26.5 billion, increase of 151.35%. And just like the free cash flow, it is very consistently growing if you see this graph. So all in all, when it comes to the profit metrics, all of these are looking very good. The only one that isn't is a little bit of the net income here and there. However, the free cash flow, which is the most important one, and the revenue are also pretty much going in the correct direction. So 2 of the 3 is not bad in my personal opinion. Now let's take a look at if they can cover these liabilities, because you don't want to buy a company that is on the verge of financial destruction. You want a company that when things hit the fan, you want them to be able to survive. So we take the assets and liabilities, subtract them, and whatever number they have left is how much they have after paying off all of their liabilities. And currently, they have a whopping $58.1 billion left. And not only that, guys, they have been increasing this difference within the past 5 years too. Average total assets around $60.7 billion. Average liabilities around $24.5 billion. And doing this difference, we get $36.3 billion. Now looking at the shares outstanding, a metric that a lot of companies tend to fail, and Salesforce is failing it. I mean, this was even surprising the first time I did it. So yeah, this is not good, guys. You want the company to be buying back shares and not increasing them, because the more that they buy back, the bigger piece of the company you own. Now, as you can see right here, 5 years ago of 730 million shares to today of 989 million shares. They almost reached a billion shares for their shares outstanding. On the 5-year, this is an increase of 35.5%. And from the previous year to the current year, we're looking at 2 years ago of 919 million shares to 1 year ago of 989 million shares. This is an increase of 7.62%. Now, you guys are probably looking at this, you're like, 35.5, that's insane. Well, understand that again, their stock price was a whopping 300. So, more than 300 actually. So, probably what happened here is that management, corporate was probably like, you know what, guys, our share price is so overpriced, we don't pay a dividend. Instead of taking on debt and actually making this assets minus liabilities look bad, let's just issue shares and not take on debt, because let's face it, we don't pay a dividend, it doesn't really matter, so let's issue these shares. Our share price is overpriced, eventually we'll buy it back. So I think that's the reason why they did it. But nonetheless, guys, just letting you know, this is still a huge increase when it comes to the shares outstanding. And lastly, looking at the cash equivalents, currently they have around $5.5 billion with an average cash around $4.4 billion. Now it's time to make some assumptions, guys. Before I go on any further, I would just like to point out that from my previous video, I actually changed up my numbers here by a significant amount, and I will go into this when I talk about these numbers, but just understand that my numbers have been changed by a significant amount, mainly because of the fact that things have changed when it comes to the economy as well as their share price. So just understand that. But nonetheless, we're going to make a low, medium, and high assumption using 3 different factors: revenue growth, predicted share buyback, and of course the required rate of return. For the revenue growth, I like to use Seeking Alpha's growth tab year over year and the revenue growth forward and make a conservative assumption between those two numbers. For the predicted share buyback, I like to use the shares outstanding graph that we just saw as reference. And for the required rate of return, keep it flat 10% to match the S&P 500. Now, for the low assumption, guys, I'm going to say a revenue growth of 6% and a predicted share buyback of -5%. This means that they will continue to issue shares at -5% into the future. Now, if you guys saw my previous video on Salesforce, you guys are probably like, whoa, these numbers are way different. They're way different than what you did before. Well, understand that, again, every investment is the present value of all future cash flow. Things have changed. The share price has fallen. The last time I did this, it had a share price of what, $200 or so? So the fact that now their share price is 165, they're probably not going to be issuing any more shares because, well, they're going to be losing money at this point. If anything, they're going to start to buy back shares, or if at worst, they will issue shares, just not at the same rate. Because remember, when a company buys back shares, they're buying it at this $165 price, the share price that is available for all of us. It made sense for them to issue 20%, 3 months ago when their share price was like a $200 or $300. Now it doesn't. Now, when it comes to the revenue growth, understand that I'm taking into account a lot more of the recession fears. We have seen companies tumble. We have seen a lot more earnings since then, and we have seen future projections look really, really bad. So I have to take that into account. That's why I'm putting it at 6% for the low assumption. And for the predicted share buyback, I'm going to put it at -5%. So with these two numbers and of course the required rate of return, this comes out to be $248.74. For the median assumption, let's say a revenue growth of 7%. For the predicted share buyback of -3%, this comes out to be $262.52. And from a highest assumption, revenue growth of 8%, predicted share buyback of -1%, this comes out to be $277.02. Now, taking a look at this in regards to debt, we're going to take the cash and equivalents and we're going to add the net debt and then add that to the market cap that the calculator comes up with. If they have more cash than debt, this number comes up. If they have more debt than cash, then this number comes down. As you can see, it does come up by around $2 or so to $250.31 for the low assumption, $264.12 for the median assumption, and $278.65 for the highest assumption. Now, I personally like to add a margin of safety, 5, 10, and 15%, just so that way I don't overpay for something, because again, every investment is the present value of all future cash flow, and the more you pay for something today, the less returns you're going to have in the future. It just makes sense. So adding this margin of safety, which by the way, you guys can change to whatever numbers you like, I personally would put this target share price now at $212.77 to $237.80 for the low assumption, $224.50 all the way up to $251 almost for the media assumption, and $236.85 to $264.72 for the highest assumption. Now guys, you can see the current share price is 165. So wherever you look at all these assumptions, it is an all-out buy, whereas I believe last time it wasn't an all-out buy. So you can see how much just these things change. First of all, based on the projections that you make into the future, and of course you have to be conservative with these things. So that's essentially why now it's showing for me that it is an all-out buy. However, if you guys don't agree with my assumptions, let's say that you think that Salesforce will continue to grow at like, I don't know, 20%, and they're going to start buying back shares at like, I don't know, 2% or something. Well, this pretty much just shows you how much these projections change by. At this point, it's even more of a buy, right? You would be getting a 10% return if you were to buy it at $420. Imagine what kind of returns you would get buying it at $165, assuming that you like the current share price and you believe these assumptions. If you do not, guys, I have this calculator available for free, as well as a book value calculator and a REIT calculator as well, and a dividend tracking sheet. I'm giving out these 4 free things. All I'm asking for in return, guys, is just help me grow my channel. Like, subscribe, comment, and just help me grow. That's really much it. Thank you so much for the 600 plus subscribers we've gotten so far. I'm gonna keep saying it until we reach 700, and at 700 I want to say thank you for the 700. I would love to reach 1,000 by the end of the year. That would be amazing. Thank you all so much, and I am more than happy to give out these free things for your guys' support, and of course me being able to grow my channel with your support. All in all, when it comes to Salesforce, yeah, this is a company that I know a lot of people like. I know Joseph Carlson likes this company. He has it in one of his portfolios. However, at least when it comes to me, the cash flow and the revenue are looking amazing. However, guys, at least for me, this is not paying out a dividend. And honestly, to me, just CRM isn't just one of those companies that really just attracts me. Maybe in the future, I will think of it as a company that does attract me, but just as it stands, it's not really that, I guess, that attractive to me at the point, probably because they do not pay a dividend. But then again, guys, this is not financial advice. You guys do whatever you want with your money. Of course, feel free to use my calculators to make the assumptions that you so wish to do so. That pretty much is it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube, as I said. You guys can follow me on my new tech sites of BitChute, Odyssey, and Rumble. I also have a Let's Play channel. The link is in the description below if you guys want to see me play Stardew Valley with my girlfriend. You guys can follow me there too. With that said, peace out, and be on the lookout for the next stock analysis of video.